The Fed is expected to maintain rates this week as the economy continues to send mixed signals. Joining us right now with the Fed preview is Jim Grant. He's the founder and editor of Grant's Interest Rate Observer. And Jim, there's a lot for the FOMC to be considering this time around. It looks like the consumer may be slowing down. It looks like some concerns around consumer confidence. We're not entirely sure about what's happening there. And we got some decent inflation numbers this past week, but I think there are still concerns about where that is headed. What do you think the Fed's going to be grappling with and what they'll be considering?
Yeah, as to inflation, as they said on your report card, that there's room for improvement. And I think the Fed is aware of that. And I think what is most notable about the Fed this time is how little it has in its direct control of things that matter most. And I'm thinking, for example, of this immense outlay of capital investment in data centers for artificial intelligence. And we happen to think that supply is way outrunning demand. And there'll be a comeuppance sometime. You know,
sometime in the near future, or are you talking a couple of years down the road?
No, sooner.
Yeah.
I'm reminded of the race between supply and demand with a fiber optic cable.
We talked about that this morning with Wendell Weeks from Corning, who lived through it.
And it turns out that was the information age, but nobody had the information.
He, by the way, thinks this time is different. We literally had him on set this morning talking about that, and he was the vice president in charge of that division when it went through that rapid growth into the collapse.
Did he say this time is different?
He did. Yeah. He said this time is different, and because he can see out at least for the next couple of years. Yeah. He says. So maybe not for forever, but for the next couple of years.
It's always a little bit different.
Yeah.
But we think that the wild card is not the supply, which is out there in public, but rather the demand, which is conjectural. And anyway, so that's one thing the Fed cannot control, of course. Nor can it control the geopolitical situation. It can't make the Navy readier than it ought to be in case of untoward events with respect to Taiwan. And that would be an immense event, of course, for humanity, for the world's economy. And I'm talking about
China potential
invasion.
Yeah.
And so that's one example of how things don't. We tend to think of the Fed as in control of events. At least unconsciously, we impute great powers to it. And the very volatility of the President of the United States, the avatar of volatility, sits in the Oval Office. And tariffs are up, they're down. So we have, besides yo-yo tariffs, we have the great scythe of Doge. And, remember the play, The 6 Degrees of Separation? John Guare. Anyway, the phrase is certainly familiar. And if you consider that every person has room in his head for like 150 acquaintances, and if you do the overlapping of acquaintances, everyone knows someone who has been doged. And I think that altogether, with the up-tempo, prestissimo pace of events in Washington, and with the uncertainty and the apprehension that comes with selective and not so selective firings within the federal government and its myriad contractors, that there is an undertow, unmeasured but still substantial undertow and of apprehension among consumers that this is part of things today. So
Greg Fleming was in your seat about half an hour, 45 minutes ago, and he said that trying to get the spending under control was key to getting back in line with the spending versus the tax receipts that we take in. You sound like you're more concerned about the short-term economic impact from what that's going to look like.
Yes, in the short term, the beneficiaries of a perhaps minor change in their tax bill are much less affected than the people who have lost their positions and are fear for others who may lose theirs. So I think that's undercutting consumer confidence, as is the stock market, which is wobbling or worse. And you see it also in there's a story about margin calls going out to people who invested in art that is not so precious as it had seemed before. So this is, it's only...
You're talking about Hunter Biden now? Where did you...
No, that's never going to go down.
You already can't sell it. Apparently there was some reason to buy it when his father was president that it is no longer...
Well, credit was more forthcoming.
That's what it was.
Yeah. So,
but what does the Fed do, though? If it sees an economic slowdown, but it's still worried about the inflation, right. where does that leave it? Because we had a survey that Steve was with us, Steve Leisman, earlier this morning, talking about how 77% of the economists that were surveyed are looking for 2 or more cuts this year. Are you in that camp?
No.
Yeah.
I think that interest rate rises are as likely as cuts. Although, believe me, I have people say, what's your high conviction trade? That's not it.
Yeah.
But we'll come to a point at which the Fed is invited to make a choice between standing up for the stock market, which is the engine of, I think, confidence and indeed of the marginal dollar of consumption among that portion of the population that is sustaining consumption, which is the upper portion of the population. So the stock market is a vital connector to retail sales and especially to services. So say the stock market takes a rest, a 25% rest to the downside. What does the Fed do? If inflation is not printing as the Fed would have it be printed, that will be a terrific test of the Fed's determination as to whether the quality of the money is meant to